We will be talking about the central bank, its balance sheet, and the money supply process. The central bank, like any other bank, has to keep a balance sheet, and the balance sheet is relevant to how money gets created in the economy. So let's start at the beginning by looking inside the central bank. The central bank has assets. They include securities, like bonds, foreign exchange reserves, like foreign currency, and loans of various sorts. Now, you may expect that securities for the central bank would only be government securities like US Treasury bonds. But in fact, now the central bank, the Fed, will include mortgage-backed securities in its portfolio of assets, which is kind of surprising since some of those securities are kind of junk. It comes about because the Fed was trying to bail out financial companies that were in serious trouble, and part of the way it did that was by buying some of the bad assets that they were holding. An open market operation is by buying and selling securities. So when the Fed buys a mortgage-backed security, that's an open market operation. It is injecting dollars into the economy and putting those securities on its asset part of the balance sheet. If the central bank sells securities like selling treasury bonds, then that reduces the money supply. When we say foreign exchange, we don't just mean directly foreign currency, but also foreign currency denominated bonds. So a UK Treasury bond that's denominated in pounds will be counted as if it's like pounds itself, like the currency itself. And finally, the loans, historically, were loans to commercial banks. The Fed's mission was to help commercial banks from going insolvent. But now, again, because of recent events, the Fed has been making loans to non-banks, like investment banks. This would have been unprecedented more than a few years ago. And why does it take the Fed to make those loans? Because nobody else wants to do it. So liabilities of the Fed include currency in the hands of the non-bank public. That's private people and corporations and businesses, and the US government. Another kind of liability is the US government's account at the Fed. So the US government has accounts at the Fed, and those are liabilities of the Fed. It's like the US government has a deposit account, check account at the Fed, put it that way. And commercial bank accounts, of course. As we've already discussed, commercial banks are required to have an account at the Fed, but they can also have excess reserves. There's required reserves, required account balances, but they can also have excess reserves at the Fed. What they do is they bring their dollars to the Fed and deposit it in the Fed just like a checking account. And also, vault cash held by commercial banks is a liability of the Fed. The monetary base, also called high-powered money, is defined as currency in the hands of the public plus reserves in the banking system. The monetary base, as you'll see in a little bit, is the basis for creating the money supply. And what happens is this monetary base gets multiplied through a multiplication effect in the banking system. So the monetary base is sort of like the base of the pyramid, except it's an inverted pyramid. It's like turn a pyramid upside down and the little narrow triangle thing at the bottom, that's like the monetary base. And then above that is a bigger chunk, and that is M1. And further above that is a bigger, even bigger chunk of money called M2. So the monetary base is where the initial stage of creating new money occurs. And also, the monetary base is the thing that the central bank directly controls. The monetary base is what the central bank can directly manipulate to be exactly what it wants. How does the Fed manage its balance sheet? How does it change the balance sheet? One way is to buy or sell securities. That is open market operations. Another is to intervene in the foreign exchange markets by trading foreign currencies or foreign currency denominated securities. Another way is to make loans to commercial banks. Those were called discount loans. That's what the discount rate is about. Finally, the Fed can actually do exchange with private individuals. So the Fed can actually write Fed checks to individual people or private companies, just like your local bank can write a check. And there you see a little clip from some business owner who got a Reserve Bank of Australia check. And in fact, when I worked for the Reserve Bank of Australia, I got paid with Reserve Bank checks. Only problem was when you took it to your local bank, they'd never seen such a thing as a Reserve Bank check. So I actually had trouble cashing it, which is kind of funny because the Reserve Bank is actually the one who creates money. So let's get into the topic of money creation, and we'll use a really simple example to illustrate that. Suppose the Fed somehow injects new money into the economy by, for example, buying some security worth $100. And let's suppose all that money is deposited in a bank, which creates a $100 balance in a check account. Now, let's suppose the bank keeps $10 in reserve. So out of that $100, it puts $10 in the vault, and then it uses the other $90 to make a loan, like to a business. Now, we're going to assume that the reserve ratio required by the Fed is 10%. So when this bank takes $100 and keeps $10, it's keeping exactly the right amount of reserves. It doesn't have any excess reserves in this case. It only keeps the minimum of $10 required. It loans the $90 to a business. The business takes the $90 and then goes to its own bank, deposits the $90 into that bank, creates a check account with it. That bank in turn keeps the minimum reserves, which is 10% of $90 or $9. That leaves bank number 2 in a position where it can loan out $81. And let's suppose this continues indefinitely. Then if you sum the amounts of the successive check accounts, first check account created has $100. Next check account created has $90. The next one after that creates is $81. And if you add them all up, the accumulation will equal $1,000, following high school math formula for summing a series of geometric payments like this. So to express this using the words we had before, there was an initial injection amount of $100 that the Fed created. That was an increase in the monetary base of $100. The required reserve ratio was 10%, so the bank kept $10 out of the first deposit and then passed that on in a loan and so on. So the formula works this way. You take the injection amount, $100 of new money created by the Fed, you multiply that by the inverse of the required reserve ratio. Required reserve ratio is 1 over 10. The inverse of 1 over 10 is 10. You multiply that by the initial injection amount. $100 times 1 over 1 over 10 is equal to $100 times 10 equals $1,000. This is the most simple example of using a formula for money multiplication. Now, in the real world, the series isn't actually technically infinite, and also very important, all the banks in this sequence only keep the exact minimum legally required reserves. They all keep exactly 10% and not a penny more. So that's important for the multiplication effect to reach the maximum possible level. We are now going to transition to actual equations with actual symbols, and the story will be similar to what we told before, except it will get more complicated. So this is the same as the textbook notation. C is currency. That's dollars that are held by you and me, our neighbor, private companies, actual dollars, physical dollars. Imagine it that way. D is check account balances, whether it's a check account balance for a private individual or a company, or even the US government for that matter, if you wanted to go that direction. R is total commercial bank reserves. That's the total amount of reserves that are held at the Fed, plus any vault cash that the commercial bank happens to be keeping. The RR is required reserves. So you look at that single R and you look at the RR, and the bank, if it wants to, can choose to set its total commercial bank reserves at the absolute minimum that's required. ER is reserves that the banks collectively hold over and above the level of required reserves. ER is important, by the way, because the bigger ER is, the less money multiplication occurs. M is the total money supply, which is equal to C plus D. The only kind of money in this little model is currency that we all hold plus check accounts that we all hold, C plus D. R with actually subscript D is the required reserve ratio. That's the amount of reserves that need to be held expressed as a percent of D, percent of total deposits at banks. So in the example we had before, that RD thing was 10%. And the delta symbol, like the triangle symbol, means change. Let's start talking about some equations, and I need to explain an equation that I wrote on page 91. Basically, where did the first equation come from? Because I think it's maybe not so clear. Okay, so here's the explanation. If you go to the textbook, it explains in the following way. Equation 1 in chapter 17 is this. It says that assuming no excess reserves, the total level of required reserves will be equal to RD times D. And RD is the required percent of deposits that have to be held as required reserves. So you know D, you know RD, you know the level of required reserves for the bank, and remember, no excess reserves in this story right now. So in the example I just had, the required reserves were 100, RD was 10%, and so D could be 1,000. That's after you do all of the money multiplication stuff. So far, so good. So, required reserves in the most simple case is equal to, that's an R, by the way, RD times capital D. Now, that means if we take the delta, the change on each side, it will look like this. Remember that RD is a ratio, so the delta action does not affect it. Which means if you divide by both sides by RD, you get delta D equals 1 over RD times delta in required reserves. And that is equation 3 in chapter 17. So the intuition is this: if somehow the government gives the banking system an increase of reserves by buying bonds, $100 worth of bonds, that means the Federal Reserve has injected 100 extra dollars into the system, which can then be used in money multiplication, and the $100 will equal the extra level of required reserves that will be needed. So if I've got $100 extra dollars to play with, then with an RD of 1 over 10, that will support $1,000 total of extra checking account balances. The delta D can be 1,000. So that's the logic, and that's where you get the equation in my page 91. So what's the intuition? Okay, the intuition is if the Fed injects, however it does it, $100 of new extra quote reserves, that is, the monetary base increases by $100, then the total money supply can increase by up to $1,000. So this is the idea of an increase in the monetary base supports a multiplicative times bigger increase in the ultimate level of the money supply. And the degree to which that $100 can be multiplied depends on the size of RD, the size of the amount of reserves a bank has to keep. So if RD equals, let's say RD equals 10%, 100 new dollars can support a maximum of 1,000 increase in, let's say, demand deposits. Okay. What if RD was equal to 50%? Then that means every time people deposit this extra money in the bank, only half of it can be used in the multiplication, then $100 increase in the money base will be able to cause an increase of only $200. Okay? 1 over the reciprocal of 1 over 1 over 2 is only 2. You multiply $100 by 2. 200 total new dollars net increase in D. But what if RD equals 1, the number 1? Then what? Well, that's like saying when the first bunch of $100 goes to the first bank, bank number 1, it all gets put into reserve immediately. So that $100 supports only $100 increase in the money supply. That's if RD equals 1. So that's where banks have to keep 100% reserves. Problem is, how are they going to make money? If I deposit $100 and it all goes into the vault, how is the bank going to make any profit? How is it going to be able to pay me interest? Okay, so I need to do a little bit more before we're done with this chapter. So you should be getting the idea now. So total reserves in this system is equal to the total of required reserves and excess reserves. Up till now, I was assuming excess reserves are 0. So now we're going to imagine excess reserves could be a positive number. Banks hold more than they need in reserves. Now your intuition, I hope, is that the bigger ER gets, the less money multiplication there will be. In the extreme case, if $100 of new money was put into the bank and ER was so high that the bank just put everything into the vault, then it's a 1-to-1 multiplication. There's no net increase in the money supply beyond the initial $100. So total reserves are the sum of required reserves plus excess reserves. The monetary base is equal to currency, that's dollars floating around or sitting in mattresses or in buildings or in your wallet, plus reserves at the Fed. So really dollars in this simple model only manifest in 2 ways. One way is a physical dollar, and the other way, that's the C, by the way, the physical dollars are the C, or the dollars that are used to be deposited into the Fed and create a bank's account at the Fed. That's what the R is. That's what we mean by reserves. Then another equation is that the total money supply is equal to C plus D. So money supply, we call this one M1. Money supply is the currency that's floating around in the economy plus check accounts. So you notice bank reserves at the Fed, the big R there, does not count as the money supply. It's just an account at the Fed. It isn't being used for transactions. Then, now, we are finally able to write some more equations for money multiplication, and I will write the big one on the next slide. So here it is, the grand equation that says, okay, if we're thinking about money multiplication, we need to think of this equation, and I'm going to give you the intuition in just a second. And I'm going to argue from intuition this way. So, this thing on the top gets multiplied by the monetary base, and that determines the money supply. So the monetary base there is like the $100 increase of new money, of reserves from the Fed, okay? And that top expression is the multiplier equation, multiplier factor. So can I give an intuition? I'm not going to work through and prove it's true. I'm going to give you the intuition about where it's true. Okay, so intuition number one, look at that top expression. Let's suppose that people keep all of their currency as people do not hold any paper money at all. The only kind of money they keep is check accounts. You and I do all of our transacting with the grocery store, with whoever, using check accounts. Then that means C is 0. There is no paper money. We don't keep it at home. It's not out there at all. We've all decided to live in a world where checks are the only form of money. In that case, C over D is 0. So forget that for now. In this world where we only use checks and we use no currency at all, okay, and a world where banks hold no excess reserves, so ER is equal to 0, the top expression is 0 plus 1, and down below 0 plus RD plus 0. C is 0, ER is 0, so that top expression is 1 divided by R superscript D times the monetary base. And that's the basic, most simple case that I started out with. No complications at all. So that's case number one. Case number two. Let's suppose people don't keep any currency, C, at all. They still only use checks. Every dollar that comes into the hands of a person immediately gets deposited into a checking account. So, once again, C over D is 0. You can forget the C over D. However, this time, banks will hold excess reserves. If banks hold excess reserves, then ER over D has a positive value. And that positive value combines with the required reserve ratio to give you that 1 over the required reserve ratio kind of effect. So as banks hold larger amounts of excess reserves, it offsets the RD to some degree. In fact, if the ER is big enough, it could completely offset the RD, and what you have is 1 in the numerator and 1 in the denominator. No money multiplication. If banks hold sufficiently large excess reserves, then there's no net money multiplication. The intuition is that excess reserves sort of have the same drag effect as required reserves. It slows and reduces the amount of money multiplication because banks are taking money out of the circulation, out of the money multiplication process. So that's case number 2, where RD is a positive number and ER is a positive number. So we sort of get the intuition there. More excess reserves make the money multiplier smaller. Finally, what about the C over D? Now the C over D is complicated because there's a C over D in the numerator. There's a C over D in the denominator. So what is it? I mean, as C goes up relative to D, does it make the multiplication greater? Or does it make the multiplication less? Because there's a CD in the numerator and a CD in the denominator. One makes things go up more, one makes them go up less. So which is it? Well, the easiest way to figure out is, let's imagine that C over D approaches infinity. That's like saying the amount of checks, deposits the checking deposits we hold become smaller and smaller and smaller, and therefore C gets bigger and bigger and bigger. And as we move toward only using paper money, only using C, and D approaches zero, then the C over D and the C over D is going to dominate. And what you get is, in the numerator, it will approach infinity. The denominator will approach infinity. And so what you get is an approach to 1 of that top expression. So the intuition is, if people only want to hold cash, and they don't want to put money in the bank, they don't want to create demand deposit account. As soon as that extra $100 lands in the laps of the regular people, it just stays there and never gets into any bank at all. So that's the end of any money multiplication. Anyway, that's the intuition. Okay, that's how I can give you a feel for why this equation is correct. So let's not get obsessed about that last equation. What's the sort of, coming back to what's the big picture, what does this say? Well, what this says is money multiplication, that is m, little m, which is what we call the money multiplier, depends on, or is a function of, behavior by 3 entities. So we're saying money multiplication depends on how 3 particular sorts of entity behave. And entity number 1 is what banks do. Okay? In particular, how much excess reserves they choose to hold. So if banks hold a lot of excess reserves, money multiplication is relatively low. And the minimum level of money multiplication is 1 to 1. Number 2, it depends on the behavior of the central bank. Obviously, because the central bank determines how much money gets injected into the system, and the central bank also dictates what R superscript D is, the required reserve ratio. And finally, money multiplication depends on the non-bank public. That's you and me, the people who are not a bank, but get to make decisions about C over D. Okay? So banks decide excess reserves, central banks decide RD, and the initial increase in money into the economy. And finally, the non-bank public, we get to choose how much of our money we hold as cash and how much we hold as demand deposits. I will finish with a little kind of historical example from the textbook, figure 17.10. In the textbook gives the story of the 1930s. And the story of the 1930s is this. It's a paradox that the central bank kept increasing the monetary base. The monetary base went up. But the money supply was not going up. How come? Because the money multiplier was going down. Money multiplier M was going down. So the central bank was injecting money into the economy, but it wasn't circulating because banks and people, as soon as they got money, held on to it. They didn't circulate it. Banks held money as reserves, excess reserves, and people held money as cash and not sort of deposit it in banks, which makes sense. If you think your bank is likely to fail, you're going to hold on to cash. You're not going to turn it into a check account. So this sort of money multiplier variability makes managing the money supply difficult. Okay, it makes managing the money supply hard because the Fed can inject all of the money into the economy it likes by buying bonds, but it cannot force banks to loan it out. Banks could choose just to sit on the money they get, and people could choose to sit on the money that the Fed gives them. So you find that even in a case like the 30s, when there was insufficient liquidity, the central bank was not able to compensate for that by increasing the money supply. Okay, so there's notes, my lecture notes. I hope this verbal explanation makes it a little bit easier to follow my notes, and we will go on to the next chapter next time.